Right. So for this session, we are basically looking at taxation. I think I'm in the wrong page there. Right. We are looking at taxation. Right. So in particular, we are looking at the introduction of VAT. So this particular session is relevant for anyone doing Tax 3761, which is the year module, as well as someone who is doing Tax 3701. So this is what we are looking at. Right. Right. Tax 3701, right, only looks at corporate tax, which is tax that is paid or that is applicable to companies. So we are looking at companies tax here. Right. Then the module Tax 3761, which is a module, covers both corporate tax, right, and individual taxation. Individual taxation, this is tax that is charged to individuals, not companies. Right, so you will see that the first half of this particular module, 3761, is actually the full syllabus of 3701. So 3761, we are doing both, but 3701, we are only dealing with Companies Act. That's why it is being covered in only one semester there, because it covers half the syllabus for 3761. Right, so for today, right, we want to look at the introduction. Right, right, please mute me.
Ntsako, can you please mute yourself?
Right, so we're looking at introduction to value-added tax. Right, sorry, my network is a bit slow, and my mouse is dragging a bit. All right. Hey, yeah, boy, okay. Right, so introduction of value-added tax. Now, value-added tax is covered by both modules there. So if you are doing that 701, that 761, you are right at home for both modules. And this is your first syllabus for both of you. It is exactly the same, nothing changes. Right, but before we go and explain value-added tax, we want to look at tax. So we want to define taxation. Right, what do you understand tax to be, good people? Right, everyone pays tax one way or the other. What do you understand tax to be? Right, from a proper definition, this is compulsory. Right, these are compulsory payments imposed, right, compulsory payments, right, imposed on citizens by a government. Right, imposed on citizens by a government. Right, to fund right. So the reason is so that the government can fund eh, expenditures on behalf of the society. Right, so compulsory payments imposed on citizens by a government, right, to fund, let me say, public or general expenditures. Right, such as health, bailout bill, right, such as education, right, infrastructure, right, etc. Right, so we have what we call in taxation, right? There is a term that is commonly used in taxation. This thing is very slow. Right, so we have what is called the social compact. Right, which underlies taxation, right, which governs the relationship, right, between government, right, and citizens. Right, citizens provide funding, right, citizens provide funding to the government, right, through taxes, and the government, right, looks after, right, the well-being of society. Right, what we call the common good. Right, covering, for example, the items that we highlighted above, like health, education, etc. Right, so this is what we call taxation. Now, when it comes to taxation, there are many different types of taxation. Right, there are many different types of taxes. Right, imposed on citizens. Right, good people, what examples of taxes can we give? Right, examples of taxes that a government can levy or that are levied in South Africa on citizens. Which ones can you give me? Right, we have normal tax. Right, we have such things as dividend tax. Right, withholding tax. Right, we have estate duty tax. Right, we also have other forms of taxes like donations. Right, donations tax. We have value added tax. Right, and many more other taxes that are applicable. Right, so all these are levied by the states on different items. For example, when we say normal tax, it is charged on income. Right, so there are many different forms of taxes, and what they are charged on also differs. Right, for example, we have income tax, which is charged on income. So if you earn income as a taxpayer, for example, you're an individual, you earn a salary, you are going to pay a portion over to the government. Or you carry on a scheme of business, you are in the corporate world, you earn profits, right? From those profits, a certain portion of that income that you have earned, right, will be taxable. Right? When you earn dividend, which is a return on investment, right, you would expect to be charged tax, etc. Estate duty, when you're a beneficiary of an estate duty, right, which is basically wealth. So this is wealth. If you receive wealth in the form of estate duty benefit, you'll be charged. This is also charged on wealth. If you receive a donation, which is a transfer of wealth from one individual to the other, right, there will be also tax. We have VAT. This one is charged on the consumption. Right, this is charged on consumption of goods and services. Right, so we have many different forms of taxes, and the basis on which that tax is charged also differs. Right, so we have just introduced in just a brief way taxation in general, right? We want to look at value-added tax in particular. So we want to look at value-added tax. Right, so obviously the value-added tax is an important part of your syllabus for test number one and also the final exam. So this is one of the topics that will always be examinable as long as it is part of your syllabus. Right, in the exam, this will probably give you anything from 15 to 20 marks in the overall exam, the last exam. Right, but in your test, it can actually carry a lot of marks as well. In test number one, maybe a similar mark, maybe up to 30% in test number one. Right, so this is one of the major topics for your test number one. At least plus or minus 30 marks will be net of value added tax. So it is very, very important that we understand VAT. Now, what we call value added tax is governed, right, by the VAT Act. Right, this is governed by VAT Act number 89, right, of 1991. Now, this is a piece of government legislation or law of the country, right, designed to address issues to do with value-added tax. So normally, if you have access to the VAT Act, right, you always rely on it when it comes to issues to do with VAT. So this is like your VAT Bible, where everything to do with VAT is actually what highlighted there, and this is part and parcel of the law of the country. It's legislated, right? So, right, VAT, right, is levied currently at 15%. Right, and previously, all right, it's currently levied at 15% from 1 April of the year 2018, right? Previously, before that date, it was 14%. So previously, VAT was actually levied at a rate of 15%. So this date is always important to always remember whenever you are dealing with VAT, either discussing VAT implications or doing calculations. Right, for anything, any transaction that occurred before that date, right, you should remember to calculate your things based on 14%. And then after the 1st of April of the year 2018, right, then anything else you should deal with VAT at a rate of what? Of 15% there. Right, so we want to look at VAT and also explaining some definitions. But before that, we want to say value added tax, right, is an indirect tax. Right, is an indirect tax, right, levied, right, on the consumption of goods and services in South Africa. Right, on the consumption, right, of goods and services, right, in South Africa. Right, so let me explain a little bit on this issue of direct and indirect tax. Right, indirect and direct tax. Right, so when you talk about direct taxes, right, we are saying the burden of compliance, right, lies with the person, right, being charged the tax. Right, for example, if you earn, when it comes to normal tax, right, normal income tax that we are busy studying in FAC, right, the company that earns the income, right? The company that earns the income, right, pays or is responsible, right, for compliance on earned income. So the company that earned the income will be responsible for submitting tax returns, calculating the tax, and making payments over to SARS. That's a direct tax. Then we've got an indirect tax, right? So we're saying the burden of compliance, right, lies with a person, right, different from the person being charged. Right. For example, when you buy bread as a consumer, right? When you buy bread from a shop, okay, right, your invoice or receipt for bread, right, will come with a charge for VAT at 15% currently. Right. So which means the amount of money that is payable over to SARS, which is the VAT, right, comes from the final consumer who is actually paying the tax. Right. However, you are not involved at the end of the day with making submissions to SARS to say this is the amount that I'm paying you for VAT. Right. The company that you're buying bread from, the supermarket, is the one that is responsible for compliance with SARS. So therefore, there is a slight difference from the direct tax here. Right. The person who is actually paying the tax, it is the consumer. Right. However, the money is going to be collected by the company, which is then responsible for submitting tax over to SARS. So that's an indirect tax. One person is the one that is being taxed, but another person is responsible for submissions. Right. But with normal income tax, if you're a company and you earn income, right, the income has been earned by you as the company, and you are responsible for settling with SARS. And you are the one who's going to be responsible for compliance. So we have a direct and indirect tax. Any question on that, good people? Are we clear? Right. So the
Yeah.
first thing on our definition is that VAT is an indirect tax system, right? Which means someone else is going to be complying with SARS who is different from the person who is being charged. So value-added tax, right? Value-added tax is levied, is an indirect tax levied on the consumption of goods and services in South Africa. Right. So you will see, as we have explained here, that when you buy bread, right, in South Africa, you are going to be charged VAT. Right. When you buy the bread, you are the consumer, you are buying from someone. So what SARS does is to put a small amount, 15% of the total invoice value that they will collect from the one that is selling. Right. So VAT can only exist when there is a sale of either goods or services by someone, right, from one person to another person. Right. If there is no sale of goods, then there is no VAT. So it's different from other taxes. For example, a donation tax. Now, donation tax is a transfer of wealth from one individual to the other. Right. Estate duty tax is a transfer of wealth from one individual who is deceased to another. So those are different types of taxes. But we are saying the base for the calculation of VAT, right, is the consumption of goods and services. Simply meaning that there is a sale of goods from one person to another. So that is what we call value-added tax. It's an indirect tax charged on the consumption of goods and services in South Africa. Right. Then we want to look at some important definitions here. Right. So number one, we have what is called a VAT vendor, or simple known as a vendor. Right. So we have what is called a VAT vendor. Right. I'll leave it like that. Right. So when you talk about a VAT vendor, right, this is basically a business, this is a business, right, or a person, right? Remember, a business is a person in his own rights. So this is a business or person registered, right, or expected to register, right, under the VAT Act. Right. So when we say expected to register, someone may have qualified for registration as a VAT vendor, but may maybe perhaps not be aware of how the system works or when he must register. Right. According to the system, if the system then discovers that that person had already qualified to be registered as a VAT vendor, but he had not yet registered, maybe because he was not aware or because of other reasons, right, he will simply be specified as a VAT vendor and will be treated as such for VAT, whether he's registered or not. Right. So this is a person that is called a vendor. Right. So what is important is that, right, we also have what we call, right? So we can say the business activities, right? The business activities, right, carried on by a vendor, or the business activity, let me say activity, right? The business activity carried on by a vendor, right, is called enterprise. Right. So a vendor ordinarily is someone who carries on enterprise, which means he's in a scheme of business. So we call that a vendor. Right. Then we say a vendor, right, carrying on enterprise. Right. A vendor who is carrying on enterprise, right, is known as the supplier. Right. Please mute. Thank you. Right? A vendor carrying on enterprise is known as the supplier. So you will see that in your terminology, when we deal with VAT, we always talk about the supplier. In this instance, we are talking about a vendor who is registered for VAT purposes. Right? And listen, please mute. Right? And the person, right, who receives the goods and services. Right? The person who receives the goods, right, and services from a supplier, right, is known as the recipient. So we talk about a supplier, we talk about the recipient when we talk about value added tax. Right. So we were just defining the important terms that we're going to rely on as we continue with our lesson. Right. So a VAT vendor, known as a supplier, supplies goods and services to a recipient. So this is what you then say, right? Right, a vendor, right, or supplier, right, carrying on a trade, right, and on supplying, right, a supplier supplies goods or services. So on supplying goods or services, right, must levy, right, must levy VAT, right, on qualifying transactions, right, at a current rate of 15. Right, so remember now we have a vendor who we call a supplier. We also have a recipient who is the customer. Right, so when a vendor is supplying the customer with some goods or services, right, as long as they are a vendor, which means they are registered on certain goods that qualify for VAT, whenever they issue an invoice, whatever price that they are charging for themselves, they must then put a markup, which is the 15% VAT that will belong to SARS. So that therefore, if I'm a vendor and I am selling goods, right, I've calculated from a management costing perspective, I've determined that the cost of goods in my hands is 100, sorry, it's 80,000. Let's say it costs me 80,000 to produce the goods, and I mark them up to 100,000. So, which means I'm entitled to 20,000 profit from my sales. Right. If these goods that I'm selling for 100,000, right, attract VAT, it is important to say if they attract VAT because not all goods attract VAT. Right. If I am a vendor, meaning to say I am registered, right, and these goods are attracting VAT on each and every invoice that I charge, I must add 15% here, which is VAT. So, which means my invoice total should now read 115,000. So, which means the recipient, when he receives the goods, he gets an invoice with a charge of 150. Right. However, we must be clear that what belongs to me is this 100,000. This is what I was charging the client. Sorry, come again. All right, let's mute, good people. If we want to comment, we unmute, we comment, and then we mute again. Thank you. Right, so 100,000 is what belongs to the vendor. The 15,000 must be paid over to SARS, but the customer is the one that is going to pay this 115,000. Right, so therefore, we have established that there is a vendor whom we call a supplier, and then there's a recipient, then there are goods that are being supplied. If the transaction attracts VAT, then we must add 15% on whatever we want as the supplier, so that the amount that is then payable to us include 15% that does not belong to us, which belongs to SARS. All right, so we must note that we have what is called output VAT. Right, remember we're still defining our few terms. Very important that we are very clear on what these terms mean. Right, this is the VAT portion. Right, this is the VAT portion on the total invoice amount. Right, collected by a vendor, right, and payable eventually to SARS. Right, so remember in our example here, right, the customer who is the recipient is going to pay 115,000. When we receive that money, right, this one in our books goes to revenue. It's our money. Right, this amount that we have received from the customer is not ours. This is a charge on behalf of SARS. We are going to collect it as the vendor on behalf of SARS. We have to pay it over to SARS. It's called VAT output. Right, because eventually we have to pay that out to SARS. So therefore, it will be regarded as VAT output. Right, at the point of collecting this amount, and before we pay over this amount to SARS, it means this amount will be a liability, a current liability in our hands, as we'll be holding on to money that does not belong to us. Then eventually, this liability, we are going to tap it to the 15,000 and then settle it over to SARS by crediting our hand. So that is what we call VAT output. Right. So we also have another important term which is called input VAT. Right, input VAT again is the VAT portion on an invoice. Right, this is the VAT portion on an invoice. Right, we have got equal here. Right, so this is the VAT portion on an invoice. Right, charged by a supplier to a recipient. Right, and paid by the recipient. Right, to the supplier. Right, so when I receive an invoice as a recipient and there is VAT, the amount of VAT is what is called input VAT. Now, input VAT is claimable from SARS. Right, if used by the recipient, right, if used by the recipient, right, to or if the goods, right, I need to, we are buying goods and services. So let's be clear. Right, input VAT is claimable from SARS. Right, if, yeah, the network is a bit slow today. I'm struggling to write. The pen is not keeping up with me. Right, input VAT is claimable from SARS if the goods, right, if the goods and services, right, acquired are used to make taxable supplies. Right, so if these are going to be used to make taxable supplies. Right, so let's go back to our discussion here. Right, let's say there is a sale of goods by a vendor, which means they are registered. Right, a vendor, whenever they sell goods, right, as long as those goods are taxable by nature, they will include VAT. They must have VAT on the invoice, but only if the goods are taxable. We'll discuss taxability later. But let's assume the goods are taxable. Right, we will discuss goods that are not taxable as we go along. Right, so if I'm a vendor and I'm selling goods for 115,000 inclusive of VAT, right, including VAT of 115,000, right? It depends on who is going to receive the goods, right? As the seller or as the supplier, I will obviously have output VAT here, right? Which is 115,000 multiplied by 15 over 115, which will give me 15,000. So this here would be output VAT, right? That is in the hands of the supplier. Now remember the amount that we have included here is inclusive of VAT. So if you want to know the VAT amount, you divide by what is called the VAT fraction. If the tax is 14%, it's 14 over 114. So we'll be able to calculate the 15,000. Then in the hands of the recipient, right, it depends. Assuming this perhaps is bread and what is buying is an individual, a final consumer. Right, this 15,000 here that we have, right, the company will not be able to claim any, sorry, the individual will not be able to claim any input VAT. This is because VAT is geared to be paid by the final consumer, the one at the end of the business chain. So therefore, if I'm just a bread consumer, I'm an individual, I'm buying bread for home, right? I will not be able to claim the VAT. VAT is paid by the final consumer. So here there will be no input VAT claim. Simple because I'm a final consumer. Now let's say the recipient here is a company and what they bought is trading inventory, right, with a value of 15,000. Now they are able to claim input VAT from SARS. They can claim this. Now this is because VAT is never meant to be paid uh, by a company in a normal scheme of business. So if I'm a company, when I buy goods and services, then I use those goods and services in my business. There is a possibility I may be allowed to claim the input tax, but only if I am also making those goods to make taxable supplies. I have to be making taxable supplies. Then I'm allowed to claim VAT because I'm in a scheme of business. I'm not the final consumer. Someone must pay the tax. So what happens when we look at supplies, we have taxable and non-taxable supplies. Right, taxable supplies, it means that I'm going to produce goods, and those goods I'm allowed to charge tax, to charge VAT on top. Those are taxable supplies. Then we have got exempt supplies. These are goods that when I make them, I am not allowed to charge VAT. So those are non-taxable supplies. So it means that if I'm making non-taxable supplies, I cannot claim the input VAT. Right. Are we clear about that, good people? Right. The question is very simple. Who claims input VAT? Right. A final consumer or any person who is not in a scheme of business cannot claim VAT. That's very clear. When you buy bread from Spar, from Checkers, there is no way where you can go and recover what your 15%. So you can't claim input VAT even though you are what a recipient. Right? If you are a business, not a final consumer, not an individual, who is going to continue with business? It depends on what you are making. If you make what we call taxable supplies, if you make what we call exempt supplies, the treatment is going to be different with regard to input VAT. If you make taxable supplies, you claim back your input VAT from SARS. If you make exempt supplies, you cannot claim. There is no claim, so you don't have input VAT. Are we clear about that, good people? Right.
Yeah.
So that therefore, when we go to the notes here and we are being specific, right, this is claimed by a supplier, right, supplying taxable, right, goods and services. This is what we call output VAT. It's associated with a supply. Then input VAT, right, this is going to be claimed by a recipient, right, who buys taxable goods or services and uses them to make taxable supplies. So this is specific. So if you make non-taxable exempt supplies, you will not be able to claim any input VAT. So that therefore, when we talk about VAT, we need to be able to calculate, right, the amount of VAT right? Payable or refundable. So a company, when it's the season to pay VAT, they need to calculate the amount, right, that is either payable to SARS or that is refundable. So an entity needs to calculate its output VAT. Right, this output VAT being the amount that the company would have collected on behalf of SARS through selling goods that are taxable and charging VAT on them. So this is what we call output VAT, and then we should less any input VAT. Now remember, input VAT is the VAT that I would have been charged uh, as a company, right, on my own purchases. So remember, if you're in business, sometimes you buy, sometimes you sell. So when you are selling, you are likely to deal with what? Output VAT, because you collect money that does not belong to you, that belongs to SARS. Right? But when you make your own purchases for supplies, you are also charged VAT on certain goods that you buy. If you use those goods to make taxable supplies, then you are able to claim that VAT from SARS. So output VAT minus input VAT, and then you add or subtract adjustments. So once you have the difference between the two figures, there may be certain adjustments that you need to make. Right, in this syllabus at this level, we are going to deal with output VAT, with input VAT. This you are going to deal with it at CTA level. Right, the adjustment. So it's just part of the formula, but not at this level. So you need to know about input, output VAT, right? And then from there, you'll be able to calculate whether you have an amount that is payable, right? Or you have a refund. Right, remember, as a company, output VAT is what you need to pay to SARS. Input VAT is what you need to claim. So if you have got a higher output tax as compared to input tax, then it simply means that you have got an amount that is payable. Right. So in other words, if I've got 200,000 payable to SARS here, right, and I've got 150,000 that I can claim from SARS, it means that at the end of the day, we do a set of I am owing SARS this amount and it's payable. If it is reversed and any particular period you have got more input tax, which means you can claim more from SARS than what you need to pay them, right? You will need to actually claim the difference back from them. So in that instance, it means you will then have what is called a refund. Right, good people, that's our brief introduction. Any questions, good people, from the floor? Right, on anything that we have discussed here? Right, so we want to look at an overview. Right, we want to look at an overview, right, of number one, output VAT. Right, we want to look at an overview of output VAT. Right, so we have already explained that VAT, right, output VAT is the VAT component, right, on invoices by a vendor. Right, so this is the VAT point. This is the VAT component on invoices by a vendor. Right, the vendor, right, collects the VAT together on the invoice total, right, together with their revenue on the invoice total, and is uh, expected to pay or is required to pay the amount over to SARS. Right, and is required to pay it over to SARS. Now we must be very clear that output VAT is, number one, only charged or levied, right, by a vendor. So you cannot just wake up tomorrow and start charging VAT. Only those persons carrying on enterprise who are registered under the VAT Act or are expected to be registered, which means they are vendors, can include VAT on invoices. Number two, right, output VAT, right, can only be levied, right, on certain supplies, right, called taxable supplies. So we have to be very clear. The person must be a vendor and the person must be supplying what we call taxable supplies. Then every invoice that they issue, if it qualifies or satisfies these two, right, must include a portion of VAT at a current rate of 15%. Right, so we have mentioned supplies here. Right, we have mentioned what we call taxable supplies. Right, what other supplies are there? So therefore, we want to look at types of supplies. Right, there are two main types of supply that we have. Right, there are two types of supplies that we have. Right, there are two types of supplies that are applicable. Number one, we have what we call taxable supplies. Right, taxable supplies, there are two taxable supplies. We have those that are standard rated. Right, so here we're saying VAT is levied at 15% of the total invoice value before VAT. Right, we also have another form of taxable supply, but this one is what is called zero rated. Right, it's a very funny looking thing when you think about it. Right, this is a zero rated supply. Right, we are saying VAT is charged at, right, this pen today is very slow. Right, maybe I must be slow in my writing. VAT is charged at 0%. Right, there is VAT, but this VAT is being charged at a rate of 0%. So for all intents and purposes, right, VAT is there, even though it will result in zero VAT being levied. Right, I will explain that, but let me explain the other supply that is there. We then have what is called an exempt supply. So we have exempt supplies. With the exempt supplies, right, we are saying here there is not going to be any VAT at all. So in other words, on exempt supply, we are saying VAT is what? Prohibited. So no VAT is levied. Right, VAT is prohibited. Right, so we call this an exempt supply. Right, this here, if you go to the VAT Act, this is actually a list is provided for you in terms of law. So this is listed on Section 11 of the VAT Act. So if you happen to have access to the VAT Act, you open the Section 11, right, they give you a full list of the zero-rated goods. Right, then the exempt goods, these are also listed on Section 12 of the VAT Act. So if you go to the Act, you open this particular page or this particular section, right, they will give you a full list of things that are exempt from VAT. So that therefore, right, if you are wanting to check to see what's happening with a particular supply, you first check if it is exempt. If it is not exempt, then it is taxable. Then to check what kind of taxable supply it is, you go and check this list. If it is not on Section 11, which is zero rated, or it's not on exempt, then it definitely falls under the standard rated taxable supply. So these are the two types of supplies that we actually have. Any question on that, good people? Right, any question on that, good people? Right, so that I'll give you a small example here. Right, let's say we have entity number A, or we have entity A or company A, right? And the company made the following supplies. Right, the first one supplied 115,000. Right, 115,000 standard rated goods. Right, figure includes VAT. Right, supplied 230,000 standard rated, or 200,000. Okay, right, let's say the company supplied 200,000. Right, standard rated. Right, goods. The figure excludes VAT. Right, the company supplied 50,000 worth of goods. These are zero rated. Right, and then the company supplied around 70,000 exempt goods. Right, the company is a VAT vendor, right, making 100% taxable goods. Right, so the company only supplies taxable goods. I'll be lying. Okay, let me remove that. If I say 100% taxable goods, they've got the 70,000. So the company is a VAT vendor. That's what they are. They are just a VAT vendor, but they provide both taxable and non-taxable, and these are taxable supplies. And this is an exempt supply. So what we want to calculate is output VAT. Right, on the first, the 115, we are going to say this is transaction. Let me just say transaction 1, 2, 3, and 4. So I'll then just say transaction 1 here. Right, remember 115,000. Right, what is important is that these are taxable, they are standard rated, and the figure includes VAT. So when I want to know the amount of VAT, it's 15 over 115, which is the tax fraction, and it will give me an amount of 15,000. So this here is the amount of tax that they are going to put on the invoice that the customer is going to pay. Remember, the customer pays the full amount there, including the 15. But this amount does not belong to the entity. It belongs to SARS. It's output VAT. Right, we also have 200,000 next. The amounts does not include VAT, but it is a standard rated amount. But it is what? Exclusive of VAT. When the amount is exclusive of VAT, we multiply by 15%, not by the fraction. Right, then we're going to have 30,000 there. So just to make sure that we are clear to calculate either way, you need to check whenever you deal with figures, whether they include VAT or not. If they include VAT, 15 over 115. If they don't include VAT, simple by 15%. Then we go to number 3. Right, number 3, we are saying these are zero rated supplies. Now, when we are saying zero rated, we are saying these are taxable. Right, SARS is going to treat them as such. So they are taxable goods. Right. This was 50,000. Right. This is inclusive of VAT. Right. But remember the VAT that was included here is 15 over. This is inclusive of VAT. This is zero rated. Remember, zero rated is charged at what? 0%. So, right, you can say multiplied, or let's say exclusive there, because it was never included. Just say by 0%, because there is no VAT that was added anyway. So you still get 0 there. Okay, right, maybe to make sense, let me say exclusive. Even if you say inclusive, it will give you the same answer. But I don't want to confuse anyone. Right, so that will be 15%. Then we go to the fourth one, 70,000. Right, so here in this instance, VAT is not applicable at all. So there was no VAT. Right, which means all in all, right, we are going to have 45,000 as output VAT. So this is my total output VAT. Right, so what will happen is I will be able to collect 45,000 from my invoices when customers pay. This amount does not belong to me. I have to pay it over to SARS. I have to claim that amount over to SARS. Now, this issue of zero rated and exempt supply, it will be more important to the recipient of the goods. It will be more important to the recipient of the goods, as you will see when we deal with output VAT. But the distinction is very important for the company. So when you interpret this, you are saying that the first 3 transactions attracted VAT at 15% for the first 2 and at 0% for the last one. But the fourth transaction is exempt. There was never a charge for VAT. Right. Any questions, good people, on output VAT? Are we clear? Right. Are we still there? Let's go to the basics of input VAT. Right. Let's look at the input VAT. Right. With input VAT, right, this is the VAT portion. Right. On invoices, right, received by a recipient and which are claimable from SARS. Right, let's talk about claimable here. Right, so you can only claim if making taxable supplies. Right, from such purchases or invoices. Right, so you can only claim if making taxable supplies, right? Right, let's be clear on taxable supplies. These are by, all right, so you can only claim if making taxable supplies from such invoices. Now remember, taxable supplies can only be made by vendors. Right? Are we clear on that, good people? If you're a non-vendor, you cannot make a taxable supply. So therefore, the only person that can claim is a vendor. Right? And also when making taxable supplies, as opposed to exempt supplies. All right, or I've already mentioned taxable supplies. Right? These are taxable supplies are made by vendors, right? And exclude, let me say, these excludes any exempt supplies. So we are very clear on what output VAT is, right? When you are charged VAT on your own purchases and you are a vendor who is making taxable supplies, those goods that you bought and then you used them to make taxable supplies, you will be allowed to make a claim on any input VAT that you paid on those goods, but only if you are going to use those goods to make taxable supplies. If you make exempt supplies, you are not going to claim. If you are not a vendor, you are not going to claim. If you are not a business, you are not going to claim. You are actually the final consumer who pays VAT. Right. Are we clear on that, good people? Are we on the same page? Right. Let's discuss this in detail a little bit. So we're going to put a few examples and then work around them. Right. Let's say that we have company number A. Right. We have company number B. Right. We have company C. Right. So these are the three different companies that we have. Right. So let's say these are newly formulated company. They were formed in the current year and they are interlinked, they are trading. Right. Let's assume that this company is a vendor. Let's assume that this company is a vendor. Let's assume that this company is a vendor. So all the companies that we are dealing with here are a vendor. Right. Let's assume this guy makes 100% taxable supplies. This guy makes 100% taxable supplies. This guy makes 100% taxable supplies. So let's say A sells to B, right? 115,000 worth of goods, inclusive of VAT. Right, let's say B sells to C. Right, let's say these guys put 100% markup, so they sell for 230,000. Right, and the figure includes VAT. Right, and this guy, which is C, right, let's assume they just bought, they haven't sold, they bought from A or from B, but not yet. So they haven't sold whatever it is that they bought. Right, I want to look at things in the hands of company number B. Right, what is company number B going to do? Right, company number B is going to have output VAT. Right, the output VAT or number B, right, it is when they sell goods, right, to C. So we have to check this company and say, is this company a vendor? This company is a vendor. That's the first thing that you check. Number two, are they making taxable supplies? This company makes taxable supplies. 100% of their supplies are taxable. So what it means, they are allowed to charge VAT on every invoice that they issue in such circumstances. Right, the amount includes VAT, which means 15 over 115 times 210, right, is going to give us an amount of 30,000. This company can actually, or this company is obliged to pay this amount over to SARS. So that represents output VAT in the hands of company number B. Are we clear, good people, on that? Right, are we clear, good people? You are very quiet. Are we on the same page? Right, are we still there? Eh, Did I mute everyone?
Ebo.
Yeah, we are.
All right, so thank you very much. So it simply means the company will be charging 30,000 on top of the 200 that they want. That 30,000 when they receive from C does not belong to them, it belongs to SARS output VAT. But this company, remember, is in the line of business. They are also into business. So we need to check on what they bought themselves. Then we can see that they acquired from company number A. The goods that they acquired were a total amount of 115 inclusive of VAT. So what it simply tells you is that company A is a vendor and is making taxable supplies. That's why they were able to levy what? 15% VAT. So therefore, it means when we pay for that 115,000, the 100,000 we are buying the goods that we are buying. The 15,000 we have been charged 15%, which is VAT. So that amount, because we are in business and because we are making taxable supplies, we will be able to claim back from SARS. That's input VAT. So that ultimately, right, Tina, we owe SARS that much. SARS is owing us that much. We need to pay. So this amount is payable over to SARS by company number B. Right, so that's the first example or first scenario that I want to deal with on that one. But let's look at another angle for this one. Right, so the circumstances are the same. Right, same example. Right, except that B makes non-taxable supplies. Right, in other words, it makes exempt supplies. Right, let's check the chart. Right, umfundo, but okay. All right, I don't think there's a question there. Right, so we want to look in the hands of B. Right, we want to look in the hands of B. Right, we're going to say, what is their output VAT? Now, what we have got to consider in this instance, right, if you are an entity and you are making exempt supplies, you are not going to charge VAT. Right, so remember, in scenario number A, we said this guy is paid 230,000, which is inclusive of VAT. This was because this company was supplying taxable supplies and was a vendor. So therefore, the amount of 230 would be inclusive of VAT. But if you are making a exempt supply, you don't charge VAT. So in this instance, there will be no inclusion of VAT because you don't charge VAT. So if you charge 230, it means that was your amount. There was no VAT there. Right? If we assume that VAT in this example was at 30%, then we can assume that now if they are selling, all right, let me make an assumption here. I'll write it down. Right, let's make their sales, right, except B is making a non-taxable supplies, right? And then we say sales to C would have been 200,000. And obviously, this is exclusive of VAT because we are not allowed to charge VAT on exempt supplies. So when the customer is now paying us, the customer is going to charge us 200,000, but is going to pay 200,000, the customer C. This 200,000 that they pay us, there is nothing that belongs to SARS there. Right. Are we clear on that, good people? Right. So output zero here will be an amount of zero. Right. Simple reason is that we did not collect any money that belongs to SARS. Now, this is different from the previous scenario. Right, because we're a vendor fully registered and we're supplying taxable supplies, when we supply, we have to put 15% on top of the original amount of 200. So that when the customer is now paying us, they pay us 200. What belongs to us is 200. 30,000 belongs to SARS. We have to pay it over to SARS. But here we did not receive anything that belongs to SARS because we did not charge it on our invoice. We were making exempt supply. So therefore, in this instance, it means output VAT will be zero. But let's look at input VAT. Now, input VAT is what you can claim, right? From what? From SARS. But the question is, when do you claim from SARS? Right? Number one, when now yourself you should be making taxable supplies, which means you are moving the system over. There is someone who is going to pay this tax, who is going to be the final consumer. But if you are making taxable supplies, you are not able to move the system of VAT forward. Why? Because when now you're not going to include VAT for someone to pay. So therefore, you are the one who is responsible for paying VAT. So therefore, in this instance, you cannot claim anything. Output VAT will be zero. Right. So ultimately, we have no input, we have no refund or payable amount here. What would have happened? Remember, the goods that you bought for 115,000 here. You will not be able to claim back the 15,000. So you are the one who is paying VAT because you are using those goods to make non-taxable supplies. Are we clear, good people, on that? Any question? Right. So in this instance, what you must note, we bought goods and we were charged VAT because our supplier was VAT rated and selling taxable supplies. But we took the goods, we did not make taxable supplies. So we can't claim input VAT. But because we are making exempt supplies, we on our invoice don't charge VAT. So output VAT is also zero. So therefore, we are saying that we are not going to be able to claim input VAT, right, on our purchases. We're not going to be claiming it back from someone. We have already paid it. The responsibility now of paying the 15% lies with what? With A. Till now we have paid over to A, including the 15,000. So that company now will take that money and give it to us. In our hands, output VAT is zero, input VAT is zero. Any question? Right, you are very quiet. Right, let's look at another scenario. Right, let's say same example as in scenario 1. Right, so we'll call this scenario 1, right? And then we'll have this as scenario number 2. So this one now is scenario number 3. So same example as in scenario 1, except that A sold to B, right? Total invoice value or total sales, right? Sold to B, right? A total of Rand 200,000 in zero rated goods. Right, so now we are looking at what? It changes in terms of company number A. Right, in number A, scenario, sorry, say? All right, I think the conversation is on the side, ne? Right, please mute. So now we are looking at scenario number A, company A. Remember here, company A initially was supposed to have sold. Let me use 100,000. Let me use 100,000. But these are zero rated. Right, so here, initially there was 115 because these were supplying 100% standard rated. Right. Sorry. Right, so this was standard rated, okay? Which means they were supposed to put 15% on the goods that they were selling. That's why the figure ballooned to 100 and what? 15. But in the scenario now, we are saying they are making zero rated goods, which means they are going to say 100,000, the original amount, right, plus 100,000, and then they charge VAT at 0%. So ultimately, the invoice is going to remain at 100,000. This is what is happening. Then B, they took the goods, they made taxable supplies, which they supplied at a standard rate. So they made standard rated what? Supplies. So when we come to this, we are going to say what is in the hands of B? What is their output? VAT. Right. What is their input? VAT. Now, these guys, when they supplied C, they charged 230,000 inclusive of VAT. They're allowed to do that. Simple because the goods that they received from A were taxable, even though at a rate of what? 0%. Right? They are a vendor themselves. They are making what? Taxable supplies at standard rated. So when you are a vendor and you are making tax rated supplies, you should charge VAT, right, at 15%. If the goods that you used to make those goods, right, were taxable. So therefore, they will have to pay over to SARS 30,000, which they will get from what? From company C. Right, in terms of input VAT, right, remember they bought goods with a value of 100,000 and tax had been what? 0% there. So they are not going to have any input VAT to claim. So they can't claim from SARS, right? Because even though the invoice is 100,000 inclusive of VAT, they actually did not make any payment over to SARS. So therefore, they are obliged to pay 30,000 a year, right, which is payable to SARS. Right. Any questions on that, good people? Are we clear? Right, scenario, right, number 4. Right, remember I said I need to highlight the differences between the zero rated and exempt supplies, right, in the hands of the recipient. So here we are saying same example, right, same scenario as in 3 above, right, except that A supplied 100 rand exempt supplies. Right, so we then used those exempt supplies. Maybe let's say we don't manufacture, but we are a retailer. So we bought something that is zero rated, that is exempt for 100,000. Then we supplied, let's say we supplied it. Right, let's say, all right, if I say that, it will be incorrect. Let's say we are a manufacturer. We bought our inventory, 100,000, which is exempt. Then we used it to make what would normally be taxable supplies. Right? We were supposed to make taxable supplies. So we need to look at output VAT here. Right? We need to look at input, sorry, input VAT. Right, let me have a look at what we did in the previous one. Right, in the previous one, right, in the previous one, that was zero rated. Right, that was zero rated from A, right, to B. Right, I made a mistake here. I made a mistake. Right, if it is zero rated, and then you use it to make taxable supply, even though it is zero rated, you are allowed to claim 15%. So here, what I described here was an exempt supply. Was it zero rated or exempt? Aye. Right, I was correct there. Sorry. Right, these guys made exempt supply. Okay, so because of that, they cannot claim input VAT. So therefore, it was zero here. But this time here, I should do the opposite. This is zero rated. Right, this is zero rated. So here we said examples except, right, this should be except 100% in exempt supply for this to make sense. Right, so what is happening here is that in this example, number A, I was explaining an exempt supply. Number 3, right, when we got the goods that we bought from A, these were exempt supplies, we were not charged tax. We then proceeded to make taxable supplies of our own. Right, that was incorrect. Right, let's explain this afresh there. I think I mixed up my things there. I was correct. It was zero rated today, not exempt. So I messed up a little bit, but it's fine. Let's have a look at that. Right, so in scenario number 3, this is what I wanted to describe. A sold to B a total of 100,000 in exempt supply. So we are saying that A is not going to claim any input VAT because we were never charged VAT in the first place. So there won't be a claim of input VAT. But when we are selling now, right, when we sell to C, right, we sell a total of around 200,000 here. Right, we are not allowed. We will not be allowed, right, to levy VAT. Right, so you cannot levy VAT. Am I correct there? So you bought exempt goods and then used them to make taxable supplies. It's fine. So let's say we made taxable supplies of 230, which is fine. We can still make taxable supplies from there. Remember, when you make goods, you have got different ingredients. Some of them may be taxables, may have been exempt. Some of them may have been what? Exempt supplies to you or purchases. Right, but you can then combine those to make a taxable supply. So in this instance, SARS was going to say, your customer is going to pay us, or is going to pay you 230,000, inclusive of 30,000 in VAT. So in this instance, the company will be obliged to then pay that amount. So that will be payable. Right, so remember, in this instance, we bought zero rated, we made taxable supplies. Now, scenario number 4 is that we got exempt supplies. The total invoice value was that. And then we sold to C rand 230,000 of taxable supplies. Right, output VAT, when we sold to our customer, these goods were taxable. And we included 15% that does not belong to us. So 30,000 is payable over to SARS. Then in terms of input tax, even though the tax was zero rated, we are allowed to claim 15,000. So that is the difference here. Right, when you buy zero rated goods, right, and you use them to make taxable supplies, you can claim input tax on the zero rated goods so that it lowers the amount that you pay to SARS. But when you buy exempt goods, you are not allowed to make any claim. So this thing of zero rating and exempt, it applies to a company that is buying, the one that was either charged or not charged VAT. Now, what is the purpose of all this by SARS? Very simple. Now, there are certain goods and services, normally goods and services that are crucial to the well-being of society. Right? For example, foodstuffs that are desirable for malnutrition, that the government is pushing to have people consume. Right? For example, meat, eggs, vegetables, rice, meal, these are basic commodities, staple foods, potatoes, and the like. So the government needs to make sure that these are provided at an affordable price. So therefore, they do allow the company that is going to make taxable supplies out of zero-rated goods that they're trying to push to claim input VAT. So thereby reducing the costs for the company that is producing these. Then undesirable goods are normally placed on the exempt list. These are such things as maybe tobacco, alcohol, sugar, etc. You'll find that as a company, you can't claim, which means that your goods will be expensive because there, as you can see, you pay 30, here you pay 15, so therefore your production costs are lower. So on the undesirable goods, you normally find them under the exempt. On the zero rated, you find them under the what? The desirable goods, you find them under the zero rated in such a way that the government is helping the poor by reducing the cost, even though no VAT was charged today. So that is the main reason. So key thing is that if I buy zero rated goods and I make taxable supply, I can claim input tax on the zero rated goods. If I buy exempt goods and I make taxable supplies, I cannot claim any input VAT. Right. So what we've done is just to have a look at the introduction of value-added tax. Right. Obviously, there is more to it. You need to go through the stuff that I have given you. And then when we meet next week, right, we are going to look in detail. Remember, this was an overview. We are going to look in detail, right, on VAT output or output VAT. Right, this is the area that we are going to look at. Right, in particular, we are going to define important terms here. Right, and then we are going to look at what is called we're going to look at what is called zero rated. So we need to look at this list. We need to look at the exempt supplies. Right, then we need to look at what is called deemed supplies. Right, once we finish this, we are done with output VAT. Right, then the following week, we look at input VAT, and then we are able to answer questions on VAT. Right, any questions, good people from the floor? Right, any questions? Right, so by the way, we are not meeting on weekend for this one next week. Right, this particular class is supposed to be, let me give you the particular day when we are meeting. It's just that we had missed it during the week last week. That's why we're making this class. It's a catch-up class. Right, so let's see. I'm trying to check my timetable here. Right, this one takes is on Wednesdays. So on Wednesday at 8:30 up to 9 p.m., that's when we are going to meet for taxation. So please note down that we are meeting next class. Right, Wednesday, right, 18:30, right, to 2100 hours. Right, and what will be the date there? Let's see. Right, the date for the next class will be when? Let's see. Okay, Wednesday, that will be the 12th. Right, so please do what we normally do best in this class. After the class, the students must find time to go through the session. Right, make sure that they understand everything that we have covered because the next class is a continuation. So very important that we all have that continuity. If you have a challenge, you are trying to go through this, you have an area that you don't understand, Monday or Tuesday during the day, you can always give me a shout and then we can discuss. So for today, I am done. Thank you very much. I will see you when I see you. Thank you.